Let's move right to the meat of our presentation today. We have Elaine Kozart with FICO. She is the client engagement consultant with FICO, and I'm going to turn it right over to her.
Thank you so much, Ellie. And thank you everyone for joining the webinar today and for your interest and seeming enthusiasm for learning more about what goes into FICO scores and how they are calculated. I'm going to go ahead and share my presentation at the moment. There we go. And can everyone see that?
Yep, you're good.
Perfect. Thank you so much. All right. So as Ellie said, I am a client engagement manager. I'm also the program manager for the FICO Score Open Access program, specifically for credit and financial counselors. So today, we're going to cover a lot of topics. I'm going to give you a little bit of history about FICO as a company. Don't worry, I won't go into too much detail there. We'll talk about what goes into a FICO score and what doesn't go into a FICO score, and we'll review ways in which this information can be useful in your counseling and coaching sessions. So a little bit about FICO. We were founded in 1956 as an analytics company. We pioneered analytic solutions, including credit scoring, using credit bureau data to make credit more widely available. And a little over 30 years ago, so the late 80s, we introduced the FICO score as we all know it today. We're really proud of the fact that FICO scores are available in 40 countries across 5 continents. We just got the update about a week ago that we've gone from over 30 countries to now over 40 countries. And those FICO scores power billions of decisions every year. Here in the US, though, FICO scores are used by 90% of the top lenders and are available through our partnership with all 3 of the credit bureaus, Equifax, Experian, and TransUnion. So another thing that I like to point out is that FICO is, a distinct player, if you will, in the credit ecosystem. We have consumers, we have lenders, we have credit bureaus, and then we have FICO. The reason that I like to share this visual is because a lot of times we're asked if we're a government agency or if we are a credit bureau or if we store consumer data. The answer to all 3 of those questions is no. We are an analytics company, and the FICO scores sit on top of the data at all three of the major credit bureaus. So now we'll move into the overview of the actual FICO score. You all probably know that FICO score is a 3-digit number that summarizes a consumer's credit risk, or put another way, how likely a consumer is to pay back credit obligations as agreed. And that's all based on the data about their credit history on their credit report at the bureaus. So with that in mind, we're going to take a closer look at the score. So first, we have the 3 minimum scoring criteria. First is, we want to make sure that the consumer isn't noted anywhere on the credit report as having been deceased. If so, that's an opportunity for them to work to make a correction on that by reaching out to the bureau, reaching out to the creditor, et cetera. And then the other 2 are, they need to have a minimum of 1 trade line open for at least 6 months, and that they also have at least 1 update on that trade line within the last 6 months. As you may know, there are a lot of different versions of the FICO score. Excuse me, on the top here, you can see we have the base score, and those range from 300 to 850, the scores that you are almost familiar with. And for housing counselors, I'm imagining that you're probably pulling FICO Score 5 from Equifax, FICO Score 4 from TransUnion, and FICO Score 2 from Experian, because those are the three versions that were originally approved through the HFHA and or FHFA. Sorry about that. And then recently, FICO Score 10T was approved. However, those probably won't be implemented within a majority of lenders, according to the FHFA, sometime in 2025. So we really want to focus on today's scores that are being used. Let's see. And now, why are there so many different scores? It's because over the years, as consumer behavior has changed, as credit data has changed, as laws and regulations have changed, we have updated the score for those purposes. So I mentioned that we have the base score that goes from 300 to 850. Then we also have the industry scores, the auto score and the bank card score, and those are from each score version as well. So if you're receiving from one of your financial institutions that you personally do business with, so maybe your credit card company or your bank, they may show you your FICO score as part of the FICO Score Open Access program. And if it's a credit card, it may be FICO Bank Card Score 9 or FICO Bank Card Score 8, based on one of these, the data from one of the bureaus. Now, it's also really important to keep in mind that although there are a lot of different score versions available, it's the lender who decides which version of the score they're going to be using in their lending decisions. So I'm sure that as housing counselors, you're all very tuned into the various housing lenders that you're working with and that you're helping your clients prepare to work with. All right, so next, the thing to keep in mind about FICO scores is that they are designed to rank order risk. So as you can see here, we have 4 different scores. Again, the scores go from 300 to 850. So this is somewhere, in the middle-ish. And what it's showing you here is that a score of 680 doesn't guarantee that an individual applicant will not go delinquent. It only means that this individual is less likely to be delinquent or default than someone with a 640. The score is a reflection of the applicant's odds of repaying their debt. So in this example, a credit score or a FICO score of 640 represents odds of repayment of 8 to 1. So, pardon me. So if 9 applicants went to a lender and they applied for a loan and they all had a score of 640 on our scoring model, we could expect that if approved, all 9 of them, if the lender approved all 9 of them, 8 would result in being favorable customers, meaning they're paying their debt as agreed, and 1 likely would not. I hope that makes sense. If you have any questions, please remember to put those questions in the Q&A box, and I'm going to get to those at the end of the presentation. Okay, so to create a score, we know now the minimum 3 criteria, or the 3 minimum criteria that it takes to create a score. And that's based on the information on the consumer's credit report. So I just wanted to pop up a kind of a sample credit report, just so you could see what kind of information is being calculated from this credit report to create that FICO score. So when you pull credit, I'm sure this all looks very familiar to all of you. But regardless of the bureau, all of the data is going to be kind of similar. So, or at least laid out similarly. We know that not every lender is going to report to all three of the bureaus. Many do, but not all of them do. And so the information may be a little bit different, but it will, it will have these 5 information zones. So, excuse me. So in zone 1, we have that personal identifying information. None of this is used in calculating the FICO score. Where a person lives, how old they are, what job they have, or how much money they have does not represent their ability or their propensity to pay their debts and to pay them as agreed. What does represent their ability or their propensity to pay is their behavior. So if they have any public records, specifically bankruptcies, if they have collection items, their trade lines. So depending on the type, how long ago it was most recently reported, when the account was opened, what their limit is compared to what the balance is, and whether or not they are current on that debt. And then, of course, inquiries also come into play. And I'm going to go into more information about inquiries, quite a lot of information on inquiries, because we do get a lot of questions about those. But these are the 5 information zones, with zones 2 through 5 being considered in the FICO score. All right. So another way to look at the data used to create a FICO score is it has to be permissible and it has to be predictive. So the data that's considered in a scoring calculation includes trade lines or their accounts, credit inquiries, specifically those hard inquiries or the consumer's attempt at gaining credit. We've got collections and then public records. And then the things that are not considered are all of these things on the right. So their age, address, employment, income, race, gender, all of those are not considered in the FICO score. So from that credit report data, we're going to break out each piece of data, and we're going to assign it to one of 5 different categories. So the 5 categories of a FICO score are payment history, which accounts for about 35% of the score. Outstanding debt accounts for about 30% of the score. Credit history length weighs in at 15%. And at 10% each, we have pursuit of new credit, those hard inquiries, and credit mix. So their mix, do they have installment and revolving accounts? So we're going to take a look at each different category, and then we'll also take a look at various characteristics, or what I like to call or refer to as the reason codes, those reason codes that come with your FICO scores when you're pulling that credit. So within payment history, some of the key factors are the recency of a late payment, a collection item, or a public record item. How severe was the delinquency? Was it 30 days, 60 days, 90 days? And how many of those credit obligations have been delinquent? So those are just 3 examples that you might see in as a reason code. We're going to take a look at one of those reason codes or key factors, also known as a characteristic. So pardon me for all the different terms, but they are truly interchangeable. In this example, we are looking at a characteristic from that first category, months since most recent major delinquency. There are many different characteristics within payment history and as well as all other categories. So this is just one example. But at the bottom of the chart, it shows the attributes or the amount of time. So months since most recent major delinquency. The first column is representing someone who had a major delinquency, or in this case, in the FICO score, a major delinquency is 90 days or more. So if somebody has a 90-day or more delinquency reported within 0 to 11 months, they represent a much higher risk than someone who whose delinquency is aging out. So there are a couple things that I want to point out with this slide, and that is that the good news for consumers is that that delinquency ages out, right? But the other thing is that you can see here that even though somebody who has no delinquency, they don't necessarily represent zero risk, because we can all come into situations where, emergencies, we had the pandemic, there are natural disasters that can really negatively impact somebody's financial situation. So FICO recognizes through many years of analyzing this data that no delinquency, doesn't equal zero risk, but it is a really tiny amount of risk. Okay, so the next category, the second category, is outstanding debt, which accounts for about 30% of the FICO score. And the key factors or reason codes would be around how much does the consumer owe? What percentage of their available credit card limit are they actually using? And we also refer to that as utilization. And then what percentage of their installment loan is outstanding? So those are all some of the things that the FICO score is looking at when it's creating a score. And so we'll take a look at it, the example characteristic of ratio of total balances to total limits on revolving accounts. So if you think about this, let's see, sorry about that. If you look at the percentages here on the bottom, the very first thing that I want to point out is really to debunk one of the myths that the FICO score wants consumers to have utilization of 30% or less. That's a myth. 30% is just that outstanding debt represents 30% of the score. So you can see here, the less utilization somebody has, the lower the risk. But when we see somebody who has a really high level of utilization, their level of risk to a lender goes up because, think about if you're in a situation where you're having to max out your credit cards just to get by, excuse me, then, that is definitely an indication that there could be something happening in the consumer's finances that is making it difficult for them to meet all of their obligations. All right, so moving on to our third category, which is credit history length. This accounts for about 15% of the FICO score. And the associated key factors include how long the accounts have been opened, or the average number of months the accounts have been opened, as well as when there are new accounts, what is the number of months since the most recent account was opened? So in this example characteristic, we're going to focus on number of months since the oldest revolving account was opened. If that oldest account is less than 2 years old in this example, and these are not hard and fast numbers that we're using here, these are just examples. But if we've got somebody whose longest opened account is less than 2 years, then they are representing somebody who doesn't have a whole lot of experience managing their credit. And so, they may represent a higher level of risk. Now, in those 2 years, if everything else is good, then they could still have a very good FICO score. This model is just showing you, or this slide is just showing you, that if their length of credit history is fairly short, they can represent higher risk just because they haven't demonstrated a lot of experience yet. But then as their experience grows, say somebody here who has 10 years of or more of experience, then their level of risk decreases. You may be asking, why is this so important? Especially if we have people who have had credit for, a short time, but they've been paying on time, or maybe they're immigrants who have had, experience with credit elsewhere. The score doesn't have visibility to that. But again, as long as everything else is good, they could still have a very good FICO score. All right, so the fourth category, pursuit of new credit, pertains to credit inquiries where the consumer is attempting to obtain new credit. So we often get questions about why a person's FICO score drops when credit is pulled. And the answer is pretty simple, just that FICO's research shows that opening new credit accounts does represent some amount of risk. Opening several accounts in a short period of time represents greater risk, right? Especially for those folks who don't have a lot of experience. But consistently paying as agreed, keeping the utilization low, all of those good habits, one inquiry should really not have very much of an impact. And it bounces back, right? You probably have all seen how the FICO score or any score really can fluctuate pretty dramatically over time. So before we look at a sample characteristic related to pursuit of new credit, we'll just take a look at the different types of inquiries just to make sure that everyone is clear about the differences. So again, a hard inquiry is considered in the FICO score. And again, that is only when the consumer is initiating an inquiry for new credit. And another differentiator here is that the FICO score is only looking at inquiries within the last 12 months. When you pull credit, the credit report will show inquiries for the last 2 years, but the FICO score only considers new, credit inquiries, hard inquiries, for 1 year. And then soft inquiries, you can see the list there, but those have no impact on the FICO score. So those of you who are pulling credit for the purpose of coaching, counseling, education for your clients, those inquiries do not impact the FICO score. All right, so in pursuit of new credit, we have a couple different factors that we're looking at in this particular category. So, or at least within this particular characteristic of number of inquiries. So we're looking at the risk patterns. The orange bars represent a young, thin file, and that is, you can think of that as somebody who has 3 or fewer trade lines and 3 or less years of credit experience. And then the turquoise, or blue, whatever color it's showing up on your screen, represents that mature, thick file. So someone with more than 3 and more than 3 trade lines and more than 3 years of experience. So you can see that the more inquiries each of these different groups of consumers has, the more inquiries, the higher the risk, right? Because if someone's asking for new credit, especially making a lot of requests, that could indicate that that consumer is in financial trouble. But you can also see that those with a young thin file represent higher risk than those who have a lot more credit experience. Again, if you have questions, please put them in the Q&A box. And before we go on to the next category, I want to talk a little bit more about hard inquiries and FICO's, what am I trying to say? Our deduping practice. So when an individual is applying for new credit, the FICO score considers that that consumer might rate shop on high dollar loans. And those would be auto, mortgage, and student loans. So when a consumer is rate shopping, they're going to apply to more than one, for more than one loan, excuse me, to determine the most favorable terms. So because of that, I mean, that's just smart financial practice, right? And FICO really encourages rate shopping. And because of that, the FICO score is going to accommodate rate shopping. So there's a lot on this slide, but what I'd like you to focus on, first I'm going to talk about this 30-day buffer right here you see in the lower right-hand corner. We're going to look at the line in the middle, the score pull date. So let's say the score pull date is today. If there was an inquiry in the last 30 days, the FICO score is not going to consider that inquiry for anything at all, regardless of the type of inquiry. So prior to 30 days, now we're going to talk about the deduping window. So when a consumer rate shops for a period of time, if they have multiple requests for credit for an auto loan, let's say, because we go into the dealer and they're going to put out your credit inquiry to 7 or 8 different companies to see what kind of terms they can get for their customer. So if let's say that doesn't happen just in one time, but maybe it happens over a period of several weeks, the FICO score is going to look at 45-day periods of time and consider all of those similar types of inquiries as one inquiry. So if it's 5 inquiries for an auto loan or it's 50 inquiries for an auto loan, as long as it falls within that short period of time, then the FICO score will count that as one inquiry. The same is true for mortgage. So those of you who are guiding your clients as they prepare, become credit ready, if you will, for a mortgage, encourage that rate shopping in a short window of time so that it can count as just one inquiry. And even better, if you feel that they are ready for that mortgage, keep in mind that within the first 30 days prior to the score pull, the buffer is going to say, oh, wait, I'm going to skip past everything that's within this 30 days and look at everything before that. Can be kind of confusing. I hope I've clarified any questions on that, but if you do have more questions, please feel free to put that in the Q&A box, and I'm going to get to questions at the end. All right, so moving on to the last category, that is credit mix, and it accounts for only 10% of the score. So the FICO score is considering the mix of credit, so credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. So mix is important, but it is only 10%. So we do not encourage consumers to go out and get an extra loan just so they have more of a mix of credit, because it's also not good financial practice to have more credit, or credit that you're not going to use, credit that you don't need. All right, again, questions on the 5 categories, let me know. And now we're going to move on to reason codes. We'll look at these in a little bit more detail. So In a couple slides from now, we're going to look at a sample scorecard. And in preparation, I wanted to share a little bit more information about reason codes so that that scorecard will make more sense. So when you get a FICO score with the credit report, you also get reason codes, and they're also referred to as score factors. And on the scorecard, you'll also see them referred to as characteristics. But they are the reasons that a credit file did not receive the maximum number of points on a characteristic within the scorecard. So the FICO score usually will return up to 4 reason codes. And then if there was a hard inquiry that was not in that top 4, that would represent a fifth reason code. Another thing to keep in mind is that reason codes are returned on that credit report in order based on the difference from the maximum number of points. So in other words, they're letting whoever's looking at that credit report know what's having the biggest impact on that individual's FICO score at the time that it was pulled. And the reason codes are delivered in order of impact, if you can think of it that way. And I'll be able to demonstrate that a little bit better when we get to the scorecard. But one more thing before we get to that is the 5 categories, just another refresh. Payment history at 35% of the score. Outstanding debt is 30%. Credit history length is about 15%. Pursuit of new credit and credit mix are about 10%. So just keep that in mind as we look at the scorecard. All right, so this is just a sample. Each FICO scorecard, and there are multiple, there are many. So as we look at this one, just keep in mind that these numbers are only examples. They are not hard and fast numbers that are going to be used in every consumer file or every consumer scorecard, I should say. But if you think about the way that this is laid out, the scorecard is composed of the category, the 5 categories, and within the categories, there's a characteristic or the predictive variable, the attributes, and then the number of points that they could get based on those attributes. Excuse me. A characteristic is predictive of the consumer's risk. So the attribute relates to what's on the credit file for this particular characteristic, and the points that the consumer will receive are associated with the attributes. Okay, so I think I've repeated myself there, but hopefully that helps to make sense of all of this information that's on the slide. So for the points, just keep in mind, the higher the points, the lower the risk, the lower the points, the higher the risk. So we're going to use this scorecard to score a file. And again, this information came from a credit report. Let's say that in this first category, their credit report returned a reason code number of months since the most recent serious delinquency. Excuse me, I have a tickle and I've not been able to get rid of it. Again, as I mentioned earlier, a serious delinquency to the FICO score would be 90 days or more. Let's see. So this particular consumer, let's assume that they had no serious delinquency. They would get 75 points. Let's say instead they had a delinquency that was within the last 0 to 5 months. They're going to get the fewest number of points. See here, so lowest risk, highest risk. Another thing to keep in mind is that within each category, in any consumer credit file, there are going to be multiple characteristics. So if you were to add up the maximum number of points from this sample scorecard, there's no way that it would equal 850. So this is just for demonstration purposes. All right, so the second characteristic, which is associated with outstanding debt, is going to be overall utilization on revolving trade lines. So utilization is determined by adding up all the revolving credit balances and dividing that by the total revolving credit limit. So let's say the credit file we're looking at has a revolving utilization of 35%. So where would that fall? It would fall right here in this the third from the bottom, and that consumer would get 45 points for this characteristic. And you would notice that the maximum number of points would be 65. And so you can see that this particular consumer, if they had a utilization in that 35% range, it'd represent a little bit more risk. Excuse me. And again, you'll see here that there isn't a specific amount of utilization that the FICO score, quote unquote, wants consumers to have. Lower is always better. 1 to 6% utilization garners the highest number of points at 65. 0 actually isn't the highest number of points because it is showing that the consumer is not actually using credit, but they only lose out on a few points. Okay. So to calculate a FICO score, the model is going to look at each characteristic in the scorecard. Again, there could be 10 to 15 for any given consumer. And then it's going to determine which attribute applies, add up all the points for each characteristic, and then the sum of those points will equal the FICO score. All right, so let's take another look and we'll see how the reason codes are derived and how they're returned on that credit report in order of impact. So as I shared earlier, when we're calculating a score, the model is going to look at each characteristic in the scorecard, determine which attribute applies. And again, there could be about 10 to 15, where here we're only showing 5. And then it's going to add up the points for each characteristic. Another way to think about these pieces of information is the characteristic is the question being asked. So for payment history, we're asking, what was the number of months since the most recent serious delinquency? Okay. And then the attribute is the answer. In this case, this particular consumer, their answer was, well, there was no serious delinquency. And then the points would be the number of points that they would earn for that attribute. In this case, this consumer had no serious delinquency and they earned the maximum number of points of 75. We're going to ignore these numbers on the far right just for the time being. I'm sure you can see where I'm going here. But let's go on to the next characteristic, which is outstanding debt, or excuse me, which is within outstanding debt. So the characteristic being, or the question being asked, what is the overall utilization on revolving trade lines? This consumer, again, had 35%, so they got 45 points. And putting this into context, if we added up all the credit available to us and divided that by the total amount, again, that's how we get utilization. So for credit history length, we're looking at the characteristic of the number of months in file. So let's assume that this particular consumer had a number of months in file somewhere between 12 and 23. So they got 35%, or excuse me, 35 points out of a maximum of 75 points. Again, as we saw on that slide earlier, when somebody has more credit history, they do appear to be less risky. So the more credit history, the more points the consumer will earn. All right, the next one, pursuit of new credit. That characteristic is number of inquiries in the last 6 months. This consumer only had 2 in the last 6 months. And so they got 45 out of a possible 70 points. And then the last one is credit mix. This particular consumer had no bank card trade lines, so they only got 25 out of a possible 40. All right, so excuse me. So now these numbers on the right, what are they? So they represent the difference between the number of points that the consumer earned and the maximum number of points that they could have earned. So the maximum number of points is indicated by the asterisk, as you saw earlier. Doing this calculation allows us to rank order the difference from the greatest to the smallest and determine which characteristics are having the greatest negative impact on this FICO score at the time of the calculation. So on an earlier slide, we delivered these results as reason codes or score factors. And I also talked about how they are returned in the order of impact. So the very first most impactful item on this particular credit file is their credit history length. So they got 35 points out of a possible 75. The most points, or the number of points that they lost, was 40. So that was the highest number of points that they lost. The second highest was here, number 2, number of inquiries in the last 6 months. And then the third was overall utilization on revolving trade lines at 3, or excuse me, was the third. So they got 45 out of a possible 65. And then the fourth reason code that you would see on this credit file would be number of bank card trade lines. This scorecard, I'm just realizing, is a little bit wonky, because here we're talking about utilization and here we say they don't have a bank card. So in any event, these would be the 4 reason codes. Inquiries was item number 2. If inquiries were not the second or the third or the fourth, then this particular consumer would have a 5th reason code. Okay, so that is a scorecard. I hope that that makes sense to all of you. If you have any questions, add them to the Q&A. I can see we're getting quite a few questions in there, so I hope I'm going to be able to cover them all. But now we're going to move on to how you can help your clients to establish credit history and to have a healthy FICO score. So just for those consumers that you're working with that are just now getting started with credit, apply for and open a credit card. If they can get a secured credit card, just have them make sure that that lender is going to report that to the credit bureau. Because remember, if it's not on the credit report, the FICO scoring model can't score it. So we want to make sure that the data is going to be reported to the credit bureau. As once a consumer has credit and they've met the 3 minimum scoring criteria, help them manage it wisely. We want to make sure that they pay their bills on time and avoid collections, that they don't use more credit than they need to. So keep their balances low. Check their credit report regularly, whether you're pulling it for them or they're going to annualcreditreport.com, or maybe they're signing up for the free version of myfico.com. just make sure that they are checking their credit reports from each of the credit bureaus. And then just to manage that responsibly, obviously, we don't want consumers to be doing any of the things here in the right column. And then there are a lot of credit myths out there regarding FICO scores, as well as regarding, any score, or, there's also confusion between what information is on a credit report and how it's used in the FICO score. If you could all just become very familiar with the credit myths and then the actual truths, that will really go a long way to help your clients to avoid any of these traps that they might fall into. All right. Before we get to Q&A, I just wanted to share with you briefly. I know I noticed a bunch of very familiar names on today's webinar, and I'm really happy to see all of you here. But for those of you who aren't familiar with the FICO Score Open Access for Credit and Financial Counseling program, I just wanted to make you aware of this free program through FICO. If you are already pulling FICO scores with credit, our program grants the permission to share the FICO score along with the two top factors or reason codes, as you saw, that are negatively impacting the FICO score, as well as lots of really great consumer education, lots of materials that we make available to you. And all of this is at no charge. You're already pulling the FICO score. You're already paying for that. We want to make all of these materials available to you. As far as showing the FICO score, we have a really simple Excel workbook where you have an input page where you can see here, there's just a few pieces of information you'll input, you'll grab it from the credit report, put it into this document, and then you'll have another tab that gives you the option to create and print out a handout to give to your client. And it shows them what their FICO score is, where the FICO score information came from, their rating, and then the top key factors with a lot of really good consumer-friendly language that helps them understand why it's impacting their score and what they need to be doing to improve their credit standing. And then a little bit of information about FICO scores. Other information or materials that we have available, we've got educational videos, each are around 2 minutes long, pack in lots of great information. There's documents and FAQs and guides and handouts. Let's see, what else? We also have a presentation that you can pop into your homebuyer education class, so that you're sharing FICO specific information and sure to be sharing accurate details about the FICO score. If you're a larger organization and you use an LMS system to train your employees, we have an e-learning course to train your employees about FICO scores. Okay, so enough about that. Ellie, I think we are ready to move on to questions.
Great. And you can give control of the screen back to Ebony.
Oh, yes.
But in the meantime, so several people asked about the slides. I will say I posted a link to our website where we post a recording of our videos after our webinars are done, and Ebony does some masterful cleanup, and then she posts it on YouTube, and you can find it on our website at the link that I posted in the chat. So that was probably 5 or 6 of the questions, Elaine. People
awesome.
Were scrambling for your PowerPoint. If you want to just say a couple of words about the reason why we aren't sharing the slides, that would be really helpful.
Yeah, so this particular deck is one that just FICO typically does not put out to the whole world. This is information to educate industry people. And so we you're going to be able to see the slides when you view the presentation on the YouTube channel. That's something that we can't control, but as far as the specific slides, that's just something that I've not been given permission to share. So.
Great. Okay. And I'm going to remind people, if you have not put your question in the Q&A box, it's likely that I'm not going to see it because the chat is kind of involved and I won't be paying attention to that. So if you have a question, please make sure you put it in the chat, in the Q&A box. All right, so this is kind of a long one, Elaine. I'm just going to read it through. Once an item is charged off, is there an additional period of time the item will continue to be on the credit report beyond the usual length of time for that derogatory information? For example, if a client has a credit card charged off, usually from the period of first delinquency, the derogatory information will be listed on the report for 7 years. Is there an additional requirement, specifically for California, for the item to continue to show on the credit report beyond the 7-year period, some sort of an additional period of 120 days added? Just was asking because I have a client who was informed by someone that there may be an additional period of time, some sort of a grace period, that a charged off item would show on the credit report beyond the regular reporting time of 7 years.
So I just want to focus on the fact that this person is asking about the credit report. If there is data in the credit report and the FICO score can see it, it's going to be scored. How long it stays on the credit report is a question that you really need to ask the bureaus. But if it's on the credit report and the FICO score can see it, then it is going to be considered. Now, there are, what am I trying to say? With regard to medical collections, that is a different thing. And that's, again, based on some recent rules around medical collections. So, you know, there are different rules around that, and I can get more details and send it off to you. But if they're just wanting to know about how long information is going to be on a credit report, that really needs to be posed to the credit bureau.
Okay, so this question is about a lot of the housing counselors are using CredCo to pull their credit report, and they don't know which version of FICO CredCo is using. The client will get their FICO score from FICO, paying for a subscription for that, and they get the FICO 8 score. Will there be any type of mandate for everyone to use the same model?
Great question. So, and there's a lot, there are multiple parts to that answer on that. So regarding housing counseling, so I mentioned earlier that FICO scoring models 2, 4, and 5 had been approved by the FHFA years ago. And, you know, we'd been trying to get them to approve more recent models. And finally, in the fall, they approved FICO Score 10T. That being said, the FHFA has on their website, I was looking at it the other day to see what the timeline is, and they're not expecting people to transition from 2, 4, and 5 to FICO Score 10T until sometime in 2025. The reasons that separate from housing, but for any lender, the reasons that a lender may hang on to an older model is simply because the work involved on the back end, and I don't even know all the details, but I do know that lenders have a lot of work that they have to do in their back end systems to be able to adopt a new scoring model and to be able to use those new scoring models. So that would be a good question as to why they do or don't change their scoring models to be posed to a lender. But those are the reasons that we are aware of.
Okay. With utilization, does the score look at individual accounts exclusively or a combination of the total amount owed of all open accounts plus individual accounts?
Great question. It's both. So it looks at the individual, each account. So if you've got 3 credit cards and they each have their own separate balances, it's going to look at that. And then it's also going to look at them cumulatively as well.
Okay. And is the inquiry a lender makes right before closing to verify credit status soft or hard?
Ooh, that's a good question.
This person says that the lenders have said that it's soft because they're verifying items have stayed the same, but just wondered if you had feedback, I guess.
Yeah, I don't know about that. That would be a question for the lender. And it could be personal preference, right? Each lender could have their own business rules around that.
Okay. For utilization, is it revolving debt that is included or both revolving and installment?
Both. Well, so for utilization specifically, it looks at revolving, but for outstanding debt, it is also looking at the percentage outstanding on both revolving and installment.
How long does a hard inquiry remain on a credit report or have an impact on the credit score?
So two answers. It'll stay on the credit report for 2 years, but it will only be considered by the FICO score for 12 months, 1 year.
Okay. This person says they've heard when a consumer is rate shopping, and there's 2 people who have kind of asked the same question. When a consumer is rate shopping, the window can be between 14 to 45 days. How do we know what time they have? I know you talked a little bit about this, but
yeah. So, you know what? That is a great clarification. With the older scoring models, that window was 14 days. So as you're thinking about housing counseling and you're advising your clients as to, when to begin their rate shopping, it would be best if the lender is going to be using a Fannie or Freddie backed loan or granting a Freddie or Fannie backed loan, they would want to stick within that 2-week, that 14-day window. From FICO Score 8 and beyond, 8, 9, 10, and 10T, it is that 45-day window.
Okay. All right. Inquiry logic. In applying for an auto loan, for example, although it's counted as 1, however, it showed 5 inquiries on the client's credit report.
Yep. It'll show 5 inquiries on the credit report. The FICO score, keep in mind, is completely separate from the credit report. It's looking at the data in the credit report, and it's going to look at those windows. So if there are 5 inquiries on an auto loan in 1 day or 2 weeks or however long, it will count as just 1 within that window of time.
Okay. If I start closing my credit cards, how will this affect my score?
Great question. So closing accounts can affect the FICO score in a couple different ways. One would be the length of time accounts were open, especially if it was your longest open account. So it will shorten that amount of time. It can also negatively impact your utilization because, let's say it's an account. I'll give myself as an example. So I had a JCPenney card. I bought a sofa, and that was the only thing I bought. The account was open for, 5 years. I never used it after I paid off the sofa. So I had this credit limit. I had, $1,000 credit limit on it. And then JCPenney closed that account because it was inactive. And so my score went down because I no longer had that extra $1,000 of unused credit in my outstanding, in my utilization. So closing those accounts does impact the score. We certainly realize that consumers are not always going to do things that make their score better, but they're going to make their financial situation better. If you've got an account and you are just too tempted to use it, it may be worth the hit to the FICO score to close the account. But in a nutshell, it does have a negative impact on the FICO score.
Okay, so it is it's 2:28. We
Okay.
are going to go over, if you have time, Elaine, to stick around for maybe an
Yep.
extra 15 minutes.
Sure.
Okay, and I know probably folks on the line aren't going to be able to stay that long, but the recording will be available so you can hear the answers to the questions.
Yeah.
Right. So, is a consumer seen more favorable when more than the minimum payment is made to creditors?
So it's not necessarily more favorable to the score. So we want to make sure that consumers are paying as agreed. As agreed means paying it on time and at least the minimum payment. Where it can positively impact the score if you make a higher payment is just that it's going to reduce the utilization and increase the amount of available credit.
Okay. What advice could we give a client who is going through a divorce and their debt is intertwined as they prepare for purchasing a home of their own?
Yes. So one point that I really want to clarify on that question is that each individual person has their own separate FICO score. Now, you may have joint accounts, but you still have your own FICO score. Again, using myself as an example, I have an Ann Taylor credit card that my husband is not on that card. So that is only reported on my credit report and it's not reported on his. But all of our other stuff is reported on both of our accounts. So, and you as counselors, I think, are much more experienced at being able to guide your clients as to how to handle their debts. But, you know, so when it's joint accounts, you know, just my advice as an individual is, you know, advise them to do what is in their best interest. But the FICO score, any accounts that have their name on it will be counted as part of their FICO score. And again, if their name is removed from an account, then that could show that they have less credit history or what have you. But anyway, it's a sticky situation for sure in terms of how I would explain or advise someone.
Okay. So I think this question is related to the part where you showed if you do this, it's this many points. And if you do this, it's this many points. Mm-hmm. You had that chart and you said, there's no way it's ever going to add up to 850. So don't try to do that. But this
on the sample. Yep.
Right. This person was asking, why did you not use the actual FICO score numbers? Are they protected for some reason?
Well, the reason that it wouldn't add up to 850 is that we only showed 5 example characteristics where a normal scorecard for like a real life person is going to have 10 to 15, maybe even more characteristics within their scorecard. So we were just showing only a fraction of the information that might be found in an actual scorecard.
Okay. If you have had serious delinquency in the past, would it ever be possible for them to reach the maximum number of points for not having serious delinquency?
Once the serious delinquency ages out, which would be the 7 years.
Okay. Please clarify 30 versus 45 days for large purchases and reporting.
30. Okay, so the 30 days is the buffer period. So if you go to a lender today and they do a hard pull, so let's say for a car loan, and they do a hard inquiry, any inquiries that you've had in the last 30 days will not be part of the FICO score, will not be considered. So it will not show as a negative hit to your FICO score. The 45-day piece is the deduping window which is, prior to the 30-day buffer, the FICO score models 8, 9, 10, and 10T are going to look at all like inquiries of either auto, mortgage, or student loans as one inquiry. So if you've got, 10 auto inquiries in a 45-day period, or in the case of the earlier scoring models, 14-day period, then that would just count as one inquiry. And it's important to know that that only applies to auto, mortgage, and student loans. Any other loan type would be its own separate inquiry.
Okay. Can you provide information on a consumer who is an authorized user and a user who is a co-applicant?
So I do know that they are both treated very similarly on older scoring models. And then in FICO Score 10T, there is 10 and 10T, actually, there is a differentiation between the two.
Is utilization only looking at revolving accounts? You may have answered this, but I'll ask it anyway. Is it not taking into account all trade lines, only revolving ones?
It looks at everything.
And I think you may have kind of answered this one also, but I'll ask again. How do we find out which FICO score is being used when we pull credit?
It should be on your credit report. And if you don't see it, go to your credit report provider and ask them where to find the version of the FICO score.
Okay. Is it better to settle or pay off a collection?
Settle or pay off? That's really a personal preference for the consumer. As far as the FICO score is concerned, paying off a collection item is not, doesn't have an impact in the older scoring models. FICO Score 9, 10, and 10T, if you're using that scoring model, it will show that it has positively impacted the FICO score if you pay that off.
Okay. Okay, so we heard that any medical accounts totaling 500 or less will not be reported on the credit as a negative. Are you aware of any other changes that are coming?
Not at the moment.
Okay. Where does the negative effect of settling a collection add to the equation? I have been told settling versus paying in full a collection has a negative effect. It's a similar question to what you just answered.
So it depends on where that collection item resides. If it is with a third party, it doesn't matter. I mean, you can pay it, you cannot pay it. If it is with the original lender and it's just moved to a different bucket, then it could have a positive impact. But again, that is with the more recent versions of the FICO score. Older versions, FICO score 8 and below, just paying a collection or not paying a collection is viewed the same way.
So we are down to the last few questions, but I do want to remind people, if you put a question into the chat, please put the question into the Q&A box if it hasn't been answered yet. Okay, after a collection falls off the 7-year period, do I still owe that debt?
That would be a question for the lender.
Okay, well, that was an easy answer, wasn't it?
Yeah, yeah.
How does removing an authorized user from an account affect the score?
For the authorized user, it just shows that on their particular credit report, it would just show that they have less, they don't have that credit line. They don't have that trade line.
Okay. And then this looks like the last question, and unless somebody pops something in while I'm asking it. Is it possible to ask a creditor to remove a paid collection from a credit report?
That would, again, that's not a FICO question. That's a credit bureau and lender question. I think it's something that you can do, but again, that's not my area of expertise. I'm all about FICO scores, not credit bureaus and reports.
All right.
Yeah.
And then the last question I have, I think I just asked it, and that was it. So that's it. Oh, wait. Oh,
All right.
one more just to clarify. So collections have no weight in older FICO scores.
No, I did not say that. So a collection item will negatively impact the FICO score. It's just that in the older models, paying off that collection does not necessarily improve the score, because it was still reported as a collection, which is well past, severe delinquency.
Okay, and one more. See, now they keep popping in.
Yes.
Which is the date to start counting 7 years open? The date of account or last activity account? Open date account or last activity account?
The FICO score is going to look at is going to consider data for the last 7 years that was reported on any account. So that's the best way I can clarify that.
Okay.
Yeah.
Yeah, I think what they're trying to figure out is it 7 years from the date I opened this account, or is it 7 years from the last time I made a payment on the account? I think that's the question.
Well, yeah. And, I guess the other thing to think about is 7 years is most often referred in reference to collections. So, if your collection is more than 7 years old, then it shouldn't be on the credit report any longer, and therefore would not be scored by the FICO score. The FICO score is only going to see what's on the credit report, with a few exceptions, right? So we've got inquiries that'll be on there for 2 years, but the FICO score only looks at inquiries for 12 months.
So I do see that a couple of people are popping into the chat box that they had been told it's 7 years from the delinquency date.
Yeah. Yep.
Okay. All right. So that's all the questions.
Yay!
And so thank you so much, Elaine, for getting through all of that with us. This was really informative and very helpful. And as always, the housing counselors have really great questions.
Yeah, so, really great engagement. I appreciate that everyone really wants to understand this and get to know this information. You're welcome, Ellie, to share my contact information in case people want to get in touch with me just with questions, or if they want to know more about the FICO Score Open Access for Credit and Financial Counseling. I am, again, the program manager for that. So I'm your resource, and I'm really happy to help out with that.
While we are wrapping up, if you want to pop your email and any other contact information you're happy